one tendency which I've found is that at the ground level, at a 50,000 feet level, we all agree that there has to be simplicity, there has to be proof of concept, there has to be transparency. But at the ground level, each quote-unquote wealth manager, whether it's an independent financial advisor or a bank RM, is trying to justify his credentials. Why? He is better placed, which is why he will tend to push a little bit more of a complex product, tend to mystify the customer by saying, you should look at this, you should look at that. So I think that is again a very big challenge. Recent developments which have happened, like the EUIN number in the mutual fund industry, I think is a great way to start looking at funds, because now you're holding people accountable for what they're selling. Lastly, I'd just like to give a small statistic, again from the mutual fund industry, in terms of the thing which I started off by saying in terms of what you can trust and are comfortable with vis-a-vis what you're not very comfortable with. I've been seeing some numbers which have come to me. In terms of debt versus equity composition of high net worth individuals. And high net worth individuals in the mutual fund industry is anything above 5 lakhs. That's how it is being classified. You'll be amazed that throughout 2009, 10, 11, 12, and now 13, as of March of those years, at least 40% of a high net worth individual's portfolio is in debt. Okay? He has shown a very clear preference for debt in this cycle, or I'm sure that there must be data supporting that earlier also. This does not include FMPs, this does not include money market funds. So as of March 13, when we've seen probably a lot of money coming into, from HNI segment coming into equities, 45% of the money is still in debt. You might call it opportunistic, but then there's a whole cycle which proves that HNI's preferred debt. And I think there's another telling statistic which is very interesting. Out of the total HNI segment of 1,94,000 crores, equity is only 40,400 crores. And we try very hard to convince an HNI to come into the equity segment. Whereas HNIs are very clearly saying, I take enough risk in my profession, I take enough risk in my business. Let my money make money. I don't want to open up a separate flank, which is as risky as what I'm doing right now. I think once we have these sort of insights coming in, we recognize and we appreciate and we respect the HNI's views or the individual's views, I think that's a huge hurdle which we will overcome. There is certainly a sort of a gap between what we want to sell and what the person wants to buy. I'm just talking about your want versus need. He clearly wants something which is debt. He will come into equity. Incidentally, there's another thing which I thought I'll also share, and this was probably the most amazing part. Since March 2009 till March 2013, banks' investment in mutual funds, the number of folios I'm talking about, mind you, the number of folios, has gone down by 66%. Corporates has gone down by 15%. Retail individuals has gone down by 10%, but high net worth individuals, a smarter investor, has actually gone up by 57%. So you are talking to a very smart and sensible individual at the other end of the table who knows what he wants. You just have to appeal to him the right way. So that, I think, is one of the things which we need to keep in mind.
I think, thanks, Vikas. I think we move forward. Axis as well as ICICI Bank, both of you have got very active wealth management departments. Are you really making money on advisory? Or is it, the cash float that makes the money? I mean, please share your experiences. I mean, do people really pay for the advice?
I am actually, I'm not in the bank, I'm in the securities company, so I don't have the luxury of the float. So it's easy for me to answer. See, it's easy for me to answer because I'm not in a bank, so I don't have float. So I have to work hard to earn everything. So we make money, so we are in the green. Yeah, we make money on advisory, but it is tough. It is really tough. So just to, add to some points which Vikas was saying, a lot has been said on opportunities and a lot has been also said on challenges, and largely all of us are aware that challenges lie around the manpower. But this room is actually not really concerned with those challenges because they are the right set of manpower. I just wanted to give some of my insights over the last 10 years, which I acquired by dealing with these high net worth individuals. That, most of these clients or these individuals are like us. So they are also driven by greed and fear. So you will see that highest amount of inflows which happen into risky asset classes like equities or real estate are when these asset classes are actually peaking. And highest amount of outflows happen when they bottom out. Actually, it should be the reverse. So, you know, the point of chasing these opportunistic returns is really the cause of destruction and the cause of trust deficit. So, and when you try to explain to them, that this is not the right way, you do asset allocation, it's always comparison with somebody else. That, that person took risk, that stock ran up, you didn't tell me to buy. So, that challenge, if you are aware and you are able to manage, I think a lot of the trust can come back because he will remember this conversation that you tried to tell him. I was with a managing director of a leading financial institution last week. The person is investing in some real estate, high risk debentures, and was telling me I will take leverage. I tried to explain that it's very high risk and you lose your capital, but it just didn't happen. Now, God forbid if something happens, I can at least recall this conversation to bring the trust back into business.
Okay, I think the key question to ask there, Dina, is whether investors, based on the advice that whether it's ICICI, Access, HDFC, whatever it is, whether the investors are actually making money, and I think that is what is more important. I think most of the banks have a very high quality research team in place, which sort of vets what mutual fund should be bought, what mutual fund should be should be available through the branches and so on and so forth. We ourselves, we are using technology. We sell mutual funds, for example, or insurance in almost 900 cities in this country. And so therefore, for you to be able to, sort of train the last, sort of branch in terms of mutual funds, insurance is difficult. So therefore, we are actually going the technology route to be able to, sort of enable our front office officers to be able to sell these products to customers. We're also using simple products to be able to sell to our customer base, especially in outside the top 10, 15 cities. So I think in that sense, I think all banks understand the fiduciary responsibility of the products that they are selling, and I think they have the requisite checks and balances to be able to sell the right product to the right customer. Notwithstanding, some of the, I think the press broadly believes that we don't have that, which I think is untrue. And from a financial perspective, I think ultimately the channel is there, the customer is there, and I think it is our sort of responsibility to showcase or to be able to advise our customers to buy as many products that he needs from a financial perspective, whether it is from an investment perspective or whether it's credit cards and housing loans and what have you. So that's really the way we will look at our customers. But if I can just add to what's been said so far, and I think one very important part is, and I think what Vikas spoke about was what Vikas spoke about was positioning of investments. I think the consumer side of our business has actually done a very, very good job. In the 60s and 70s, it was not considered to be, sort of good to go out and spend money, buy expensive cars, expensive jewelry, whatever it is. Today, you go to a mall and everybody is carrying 6 bags, whether it's clothes or shoes or whatever it is. People have big credit card bills. People buy a car pretty much in their first 5 years of their job and so on and so forth. So I think India has modernized from a consumer perspective, but we have not modernized from an investment perspective. So I think whenever we think of investments, we either think of fixed deposits, real estate, or gold. And I think it is the collective failure of financial services that we have not been able to position our products that they do serve a need in the short, medium, and long term. And so therefore, the investor does not, as you rightly said, does not see the want. I think it is also our responsibility to create that want. That, putting money into a fixed deposit, for example, will not even beat inflation for you. I don't think we've been able to, get that message across to customers as well.